Good evening. I want to welcome everybody once again to the CFA Society of Mississippi's 18th annual forecast dinner. I just have actually another programming amendment. It is not the policy of the CFA Society of Mississippi to do these on the cusp of global upheaval every year, but we have a good track record of that lately. So my apologies. I apologize on behalf of the society. It is times like these when the expert advice and insight that our panelists have to offer are going to be the most valuable and hopefully bring us the most peace. So I just want to sincerely thank everybody for coming out. It's going to sound like a cliche when I say that this event would just not be possible without you, but this is absolutely true. We say it every year. We are a small society, but we have one of the largest and most vibrant forecast dinners. And the recognition we get from other societies and the support from our sponsors would not be possible without a consistent and enthusiastic membership that they bring tonight. The forecast dinner is the crown jewel of any CFA society, and ours is absolutely legendary amongst societies in America. So you are at a legendary event. You're welcome. You truly make this the premier event. I do want to thank our sponsors. At the platinum level, we have J.P. Morgan, we have BlackRock, we have Southern Farm Bureau Insurance, and Alpha Architect. Gold level sponsors include John Hancock, Duncan Williams, and New Perspectives. Silver sponsors are Truist, Wasatch, and Stiefel, and of course we couldn't do it without our bronze sponsors as well. If you wrote one of those sponsorship checks, you're probably about to ask me, what did I do it for? You did it so that we can support the next generation of finance professionals in Mississippi and our new territory in northern Louisiana, which we stole from the rest of Louisiana. The Louisiana takeover purchase. We offer scholarships to help students and professionals pursue the CFA charter. It allows us to fund the CFA Society of Mississippi Award, which we will announce right now. This is given to a student who excels in finance and intends to pursue the CFA charter. It is offered at numerous colleges and universities in Mississippi and, of course, northern Louisiana. And I'm so excited that most of our students are here tonight. We will recognize them now. For the audience, please hold your applause until the very end. And for the students who are being recognized, just please stand up. Your awards are on this table for after the dinner. Please make sure you pick the one up with your name on it. Please make sure you deposit the check. I know it's kind of old-fashioned. If you're here, stand up to be recognized. If you are watching on the live stream, please also stand up to be recognized. Our winners are Megan Alexander from Belhaven University. Please hold your applause until the end. We have a lot of amazing students to honor, and we want to get through them in a timely manner. Richard Pollan from Centenary College of Louisiana. Tyrell Goldsmith of Delta State University. Aaron Ridley of Jackson State University. Gabriela Catano de Jesus of Louisiana State University of Shreveport, Annalise Russell from Louisiana Tech University, Paul Thomas from Millsaps, Faisal Muhammad from Mississippi College, Austin Williams from Mississippi State University, Landon Terry from the University of Mississippi, John Leonard from the University of Southern Miss, and that is all of them. You can clap now. Thank you so much, and congratulations. Don't forget, we have something for you. Sponsors also allow us to continue to support and provide awards for teams participating in the CFA Institute Research Challenge. Millsaps is a consistent participant, and they have just won the 2022 Mid-South Research Challenge hosted in Memphis. From here, they're going to move on to compete in the sub-regionals against schools across the Southeast and hopefully go on to compete against many more schools from there. This is an absolutely phenomenal job for an absolutely phenomenal program. Way to go, Millsaps. Another very important and pretty cool program we've started is our enormously successful Ethics Challenge. We have hosted one of them before everything happened. Our inaugural challenge was hailed as the best by the CFA Institute. They really loved it. So a big thanks to Paula Nielsen for what she has done with that and for bringing it back for the 22-23 school year. So look forward to that. Now I would like to take a moment of personal privilege. It has been an absolute honor of mine to serve as the president of the board of the CFA Society of Mississippi and Northern Louisiana, and to give back to the society and the industry that has given me so much. It was actually at seeing a forecast dinner here that inspired me to volunteer so many years ago. I was just wowed by our expert panel, and I wanted to contribute. I had so many big ideas about what I was going to do, and I very quickly found out that it was not that easy. So this year, I want to recognize Davis Bourne. He is our forecast dinner chair. He has carried this immense weight during this very unsteady time. And in 1 hour from now, when we are all getting up to go, he is going to be the most relieved person you have ever met. So here is the nervous Davis Bourne right now. And I did provide him with a copy of my comments beforehand, so he knows that. The rest of the Forecast Center Committee is Jonathan Pace, Jonathan Wade, Dr. Walter Neely, Tony Edwards, and Zach Farmer. Last but absolutely not least, we want to thank Mary Margaret Pritchard. She has been our Employee of the Month since July 2019. As the Institute puts more responsibilities and more activities for the board to do, Mary Margaret is the one who keeps us on track. We are immensely grateful for her work. And finally, I see a lot of folks are finishing up their dinner, and you want to figure out what is happening in the world today. So now I'm going to turn this event over to our moderator and master of ceremony, Dr. Marcelo Eduardo. Dr. Marcelo Eduardo is the Anderson Distinguished Professor of Finance and the Dean of Mississippi College's School of Business. Dr. Eduardo joined MC's faculty in 1997 and currently teaches financial management. His areas of expertise include banking and corporate finance. Dr. Eduardo obtained his bachelor's degree and master's in business administration from Delta State University, sitting over there, and his PhD from the University of Mississippi. In his role as dean of the business school, he is the host and moderator of Mississippi College's well-known speaker series and has interviewed luminaries such as Steve Forbes and Condoleezza Rice through that. Dr. Eduardo attends First Presbyterian Church of Jackson. Ladies and gentlemen, your master of ceremonies for the night, Dr. Eduardo.
Good evening, everybody. Very honored to be here, and I know that we want to get to our speakers right away, so it is my privilege to introduce them, and what I'm going to do is I'm going to ask them, as I call their names, to go ahead and make their way over here. You have their full bios in front of you, and I know the last thing they want me to do is to call out that, so I'm just going to introduce their names and just say a little something about me. And so let me begin with Michael. Michael, if you make your way. Michael Scanlon is the Managing Director and the Portfolio Manager at Manulife Investment Management. Previously, he was a Senior Investment Analyst and a member of the Intrinsic Value Team, covering financials, information technology, consumer staples, and consumer discretionary sectors. Michael Scanlon. Michael, welcome. Next, we have Meb Faber. Meb, would you make your way here? Meb is a co-founder and the Chief Investment Officer of Cambria Investment Management. Meb is the manager of Cambria's ETFs and separate accounts. He's the host of the Meb Faber Show and a frequent speaker and writer on investment strategies, and has been featured in Barron's, the New York Times, and the New Yorker. Meb, welcome. And finally, Ken Woods is the chairman of Asset Preservation Advisors, which he established in 1989 after a long and successful career in the investment industry. Prior to forming APA, he was vice president and manager of Bankers Trust Southeastern Global Market Division, which is located in Atlanta. Ken, welcome. Thank you. Absolutely. Gentlemen, we're glad to have you here. What I want to do, and this is very loose, not a very rigid structure, is I'd like to talk a little bit about current events and more of a short-term approach first, and then I'll go into maybe a little bit more of a long-term forecast, fundamental discussion about investment. So this is my first question, and is the question for the entire panel, and I'll ask Michael to tackle it first. And the question is, just giving you some context, if you think about the last time we had this dinner, since then we've had a pandemic, one of the fastest bear markets in history, a zero interest rate environment, shutdowns, vaccines, and then one of the fastest bull markets in history. And of course, we wake up this morning and we have this developing situation in Ukraine. So, my question, Michael, what is your take on the current environment, and what do you see happening in the near term?
Sure. Well, first off, thanks for having me. Really appreciate the opportunity to share some thoughts with you tonight. I think when you look at the current environment, I think there's a lot of different moving pieces geopolitically, obviously, and then if you kind of extract that and think about the markets overall, I think we're headed into a period where you're going to see a lot more muted absolute returns in the market and just a heck of a lot more volatility, right? You've certainly seen that to start the year here. I don't really see a compelling reason why that would actually cool off, especially as you're heading into this cycle where the Fed is going to be fairly aggressively raising rates, we would expect, right? Maybe that number came down a little bit after today's events. But I think that those are going to be sort of the overwhelming characteristics as we think about the near term as the Fed. I believe the date of the Fed hike, the first Fed meeting is March 19th, so we have that kind of on the near term horizon.
Correct. Matt?
That sounds like a dry cough. Anyone think that? I mean, I'm going to
okay.
go. They kept asking me, they said, Matt, are you still coming to this panel? I said, I don't know, you guys still having it? And they said, well, you live in California. I said, well, they said, well, Mississippi's open, just so you know. But this is cozy, I like this. I like it when you have panels where you disagree, but sadly, I mostly agree. If you look at the world, and I like to take a long-term perspective. I know the question was a little more shorter term, but I think I'm a quant, and so the technical academic description of where we stand today is the opportunity set just really sucks. That's the technical term for the students that are here. But if you look at U.S. stocks in general, I think there's a pretty good case to be made that they return on a real basis a straight up bagel or a donut for the next decade. And zero doesn't sound like much, particularly when you look at investor expectations. Investor expectations, most pension funds, corporate plans expect about 8%, right? Nominal. And but if you look at a lot of the surveys over the past couple years, past 5 years, they kept ratcheting up, 8, 9, 10. And you had a couple last year where the U.S. was the highest expectations in the world, and this is always true, right? Price sentiment follows price. So whatever's doing well tends to have the best sentiment. People are excited. They're thinking about vacations they're going on, cars they're going to buy. There was a couple of surveys that had 17% expected returns. Those of you who are planners can recognize that with conversations with clients where people are getting a little over their skis. But the reality is that valuation has a weight over time. And so that has a very real gravitational pull. So we think U.S. stocks, market cap weighted, are straight up probably a 0. Bonds are easy. You know, treasuries, 2%, that's what you're going to get. It's like a 98% correlation. Inflation's the hard part, right? Is it going to be 0? Is it going to be 2? Is it going to be 8%? But nominally speaking, you're going to get 2. So that opportunity set is not great. We think there's a lot of other ideas, things you can do, move away from that. But I'll pause there and nod to my very close friend over here. See what he has to think.
Well, these are two equity guys over here, basically. And my long career in the fixed income area, bond traders, bond people, and so forth, tend to be on more on the negative side. And so I have to kind of differ a little bit about the long term and near term here, so forth, as far as what's going on. The Federal Reserve has got themselves boxed in. They should have raised rates last year, and they didn't do it, and they thought it was transitory inflation. So now they're confronted here with a geopolitical situation that's pretty difficult. So how I read this, so forth, is if you look at Ukraine, you look at Russia and what they export from raw materials and so forth. Russia is number one in exports of aluminum and also to fertilizer. So this is going to have a pretty significant hit for us, I think, long-term wise, well, near-term wise too, though, for inflation, on top of what we got right now, you know, the bottlenecks we got in California and so forth. But I'm concerned, and I hate to be this way, this is the way, you know, I feel, but...
Well, you said bond guys are grumpy. It's just,
yeah,
you don't have to apologize.
They used to call us the bond vigilantes a long time ago. But so you look at that and you say, okay, well, we've got the Fed is going to probably start raising rates here, probably in March and so forth. Whether they do a quarter or 50 basis points is debatable. But I think they've got a difficult job here, and I think we're looking at the situation as far as what the Ukraine and Russian situation is, as far as inflation. It's going to layer in another level of inflation in this country. So going back to the curve, we've been trying to stay short duration-wise. Our duration bogey is around 4, a little over 4. We've been trying to keep that under 4 for the last month or so. And so I don't see how the 10-year, the longer-term bonds can really spike much, even though we have an additional level of inflation. There's still a lot of demand for treasuries, long-term treasuries, from pension funds to life insurance companies and so forth. There's international. So I would say that we probably are going to be running into some pretty difficult times, especially in the next 6 or 9 months. So I hate to put a spell on that, but I mean, that's the way I feel right now. I'm worried about the Ukraine and how it can be inflationary for us.
Michael, how would your answer been different if the Ukraine's escalation had not been there? Would that be made any difference?
You know, certainly concerning and you know, from a human standpoint, disheartening to see the news. But you know, I would say to what Ken was saying before is, I think there was this thought process that a lot of company management teams have been talking about in the back half of the year, that they were thinking inflation pressures are going to ease from an input cost perspective. And we, frankly, even before today, were of this opinion that I thought that input cost inflation was going to get far worse before it got better. The reason why we were at that conclusion was leading up to the Olympics, there was a lot of shutdowns in kind of key provinces within China in terms of manufacturing and key port cities that were reported in the press. And as we talked to the companies that we invest in, or companies that we were thinking about investing in, every one of them was telling us that it's even worse than what's being reported. So we know China's going with a no COVID policy, right? And they have no natural immunity, a very low efficacy in terms of a vaccine. On the other side of the Olympics, it is inevitable that they're going to have a heck of a lot more COVID. So I expect those shutdowns are going to pick up pretty materially, which is going to lead to more inflation anyway. the Ukraine situation with some of the categories that you're talking about, I mean, that only, multiplies it and makes it worse. But I do think we're in for this period where, anybody that thought that the inflation issues that were going to be solved in the next 6 months or something like that, I mean, there's just nothing to back that up. I mean, as we talk to company management teams, if they would say, we think by the back half of the year this is going to be cooling down, we would ask them for some sort of tangible evidence on that, and it was really just that time was going to cure all wounds. I don't see the solution to it right now, and so I think that, from that perspective, I think inflation's here to stay. And I would expect longer term, because of re-onshoring and those trends, the last 10 years we've had 2% inflation to deflation. That period's over. We're going probably 3-4% inflation pretty steady going forward, I would think.
Meb, given the things that we just talked about, how are you positioning your portfolio? Do you have any specific sectors that stand out now?
I was just smiling internally as we were talking about inflation, because I said last night I was in Mississippi and I had a $9 beer, and I said, y'all, that sounds like a lot. And the best part is he came back to the table, he said, we're out of that beer. I said, okay, well.
So you drank the $18 beer?
Yeah. When you talk about positioning, we talk a lot about a starting point, and what does it mean from what is your framework, from where do you begin? And we're very much global investors, and we did a podcast this week with an academic that talks a lot about this, and said, what does it mean to just go out and buy everything in the world? So if you want to just index, like the ultimate Vanguard style global market portfolio, what if you just bought everything? Public security, what does that look like? You end up with roughly half stocks, half bonds, and of that it's roughly, it's a little bit more now, but half US and half ex-US. And that portfolio kills over time. I mean, that's a really hard portfolio to beat. The beauty is in 2022, it's hard to say now, you can get that portfolio for zero. So for the people in the audience who haven't quite grasped that yet, your competition, the true definition of a commodity is something that can be replaced. You can buy a portfolio of ETFs or whatever for 0% today. Including short lending, it probably has a negative expense ratio. So you get paid to own that portfolio. Think about that. And that's a really high bar. Anyway, to me, that's the starting point. Does anyone actually own that portfolio? Not really. The vast majority of people in this audience, I would venture nearly everyone, if I asked you how much US stock exposure do you have, and we actually used to do this where we would pass out a little piece of paper, say of the total of your stock portfolio, how much do you have in the US? And it was always the same, so we stopped doing it. And the answer is usually around 80%. Well, the US as a percentage of the world is only 60 market cap. So you have a very strong overweight bias to the US. And if that's you, can currently pat yourself on the back, congrats, because the US has crushed over the past decade. But that's not normal. The decade prior, the US is one of the worst performing countries in the world, stock market. And if you were to look at US excellence, it happened in the 90s. I graduated from college. We were talking about this earlier. I graduated the peak of my favorite bubble, the internet bubble, 2000. US crushed then. The last time before that, the US beat an equal weight or GDP weight of the world, 1910s. I don't see too many investors here that were investing in 1910s, but that's a long time. But investors love to extrapolate the recent performance into the indefinite future. But the reality is like US stocks versus foreign is a coin flip. Historically, it's 50-50, which outperforms the other. And betting on any one country, as we saw today, I think is a really, really, really foolish idea. Because almost every example shows that when you concentrate in one country, the US 100 years ago was an emerging market, right? Less than 15% of global market cap. That path was not preordained. I think you would have bet a lot of people 100 years ago would have said, you know what, Argentina looks pretty good. That's you know, they used to say Buenos Aires is the Paris of South America, right? You know, and here they are at a rounding error % of global market cap. So anyway, I think it makes sense to diversify globally. I think a lot of the valuations elsewhere are cheaper, on and on, but we can get into that more later.
Yeah. Michael, how about your positioning of the portfolio?
So I would, you were looking for this. I would take the exact
Finally,
opposite
God.
side of it. So the strategy that I run can go 0 to 35% non-US. If we went back to, you know, the period prior to the financial crisis, we used to use that 35%. And today it's essentially as low as it's ever been, and it has been that way for the period that you're talking about, the last 10 years or so. I just think when you look at the US versus the rest of the world, we might only still be in the early innings of this dramatic outperformance that the US has seen. And I should preface that, right? I have voted in 6 presidential elections, 2 Democrats, 2 Republicans, and 2 write-ins, so this isn't partisan politics. I can just tell you, and I probably just lost the whole room with that. I think when you look at the US between demographics, right, there's always these negative articles being written about the US in terms of demographics, but we're the only developed market in the world that's adding 30 to 49-year-olds, right? Every other developed market in the world is losing 30 to 49-year-olds, and a lot of emerging market countries, including China, have a decline in 30 to 49-year-olds. That's the most critical part of your demographic because that's household formation years, your peak spending years, and it's really a big contributor to the country. In addition to that, you know, when we talked about inflation and re-onshoring, if I was sitting up here 10, 12 years ago and told you that Taiwan Semiconductor, Micron, and Intel combined were going to spend $100 billion to build factories to build semiconductors in the United States, hopefully you would have laughed me out of the room because it wouldn't have been happening. So I think when you think about that cocktail of re-onshoring, very healthy demographics relative to the rest of the world, and just business mix, right? Ask yourself this question: what's the best search engine on earth? It's Google. That's an American company, right? So when you think about it and you put all that together, I still think that the U.S. is is going to treat your assets the best, especially on the equity side. I do agree with what you're saying about in terms of lower returns. That I totally agree with. But you know, in terms of getting free management through, you know, you talked about a Vanguard product. I think today you really have to be focused on security selection. And that involves, you know, paying for active management. Yes, I'm talking my own book here. But, you know, I think in this kind of a market where you're going to have much lower absolute returns, you got to generate alpha from picking stocks or picking bonds or doing a good job managing commodities, whatever it might be. But, you know, I would say you still got to be focused on the U.S. over the rest of the world. And 2 biggest things, too, right? Emerging markets overall, where a lot of people are focused on. Emerging markets are short healthcare and they're short tech. Is that 2 things that you want to be short going forward? I would say no.
Ken, I know you briefly referred to this, but what about your perspective? What's the strategy for a bond person in the short run?
That's the answer, is the short, short part of it. But I think you're going to have the short end of the curve is attractive today. I think, even though we're going to start seeing some rate increases from the Federal Reserve. So if you look at like the 10 years, about $1.95, about 1.95%. The 5 years about a 160, and the 2 years about a 140, 145. So I think the strategy here is, especially since this Ukraine-Russian situation, I think it's best to stay in the short end and so forth, and let your portfolio roll down. So that's what we're doing right now.
Ken, do you worry about, you know, when you think about higher rates and the impact on corporations, right? There's an article every day about how much debt is out there.
Yeah.
How do you think about higher rates in terms of impacting corporate balance sheets?
That's a good question, because it's serious, I think, right now, because you've got so much debt out there. So the last 7 or 8 years, we've had increases in the debt, world debt. It's just phenomenal. I think world debt right now is about 300 trillion. We've added about 7 trillion in the last year and a half. So, and I think eventually that's going to be negative going forward for corporations, especially if they're doing floating rate.
Yeah.
If they haven't got it fixed in and they're doing floating rate, I think it's going to hurt them a pretty good bit.
So I had seen a statistic recently that said if you looked at the S&P 500 today versus 2007, it was 50% of the debt that the S&P 500 constituents had in 2007 was floating rate. and 50% was fixed rate. And today that number's over 85% fixed rate.
Fixed rate.
So when you think about, the boom, doom, and gloom of higher rates,
Right.
think about the fact that these CFOs have done a very good job in terms of locking in fixed rates. So even as we do go on this hiking cycle, it's probably, I agree with you, there's a ton of debt out there, right? And the Fed could choke off the economy very, very quickly, but I don't think it's a corporate problem at this point.
No, you're exactly right. They have switched from floating to fixed, and most municipalities have been doing the same thing.
Yeah.
Since the rates have been so low, why not do that? So, but the corporate calendar the last year has been horrendous. Like you said, the CFOs are out there going, "This is cheap money. Let's lock it in."
For a
5
longer
year,
period of time,
longer
too,
period,
right?
5, 6, 7 years, and so forth. So I think you're right. I think it's not as going to be a big a problem as it has in the past.
I want to stay on inflation just a little longer, and I kind of got the hint from Ken's comments that, which was my question. Do you think that the Fed just got caught on the inflation issue and they were not attentive enough?
For me?
Yeah.
I think, absolutely. I think that they assumed that this would be transitory. And, the bottleneck in LA and so forth, all these things that have been screwed up from China and everything else as far as the supply chain is concerned, I think that, and I can't really criticize them because you don't know at that time. At that time you could see that there was actual reason for inflationary pressures was bottlenecked from the coast and from China. So I think they did the right thing. I think they could have been more aggressive prior to that, in my opinion. They should have probably, in 2019, the latter part of 2019, should have been increasing rates at that time.
And,
I
go ahead.
have a unique perspective there. I have a theory that every time the Fed meets, they go hang out, they throw on Netflix, they get a 6-pack of beer, maybe a 12-pack, and they pull up a chart of the 2-year, and then they just peg the Fed funds rate to that. If you look back in history, by the way, these two time series are near identical. And I said they don't really do anything. They just peg it to this, and they just say they do a lot of stuff. But I say that mostly joking, half joking. But if you do think about inflation, this is the biggest thing that you should be thinking about as an investor. And why is that? Well, a lot of portfolios are very poorly positioned. I see a lot of gray hairs in the audience, a few no hairs. You probably remember the 70s. The 70s were not a fun time to be an investor. And we do polls all the time on Twitter and elsewhere, and we ask people, we say, do you have any real asset exposure? Real estate, REITs, commodities. I come from a farming family in Kansas, Nebraska, so we've been very keen looking at wheat prices recently, all-time highs. If you guys remember back to the last time food prices are where they are, we had the Arab Spring, right? It has very real geopolitical impacts. How many investors have actual exposure to those? It's almost none. Canadians, Australians maybe, but actual commodity, real asset exposure. Tips, you could throw tips in there. Very few people have exposure to inflationary exposed assets. And if you look at the last year or two, my God, a lot of those investments have just been going through the roof. And theoretically, it could go a lot higher. Copper's near an all-time high. Many markets already are. But thinking about the real return of assets, and I'm going to say one more thing and then I'll pause, but a lot of people think the safest investment in the world, if I was to ask y'all, say, what is it? It's T-bills, right? Short-term government bonds. And you ask people, what was the real drawdown on bonds? So including inflation, most people say 5, 10%. It's 50. It's actually over 50, on the 10-year. And that's most countries around the world, but that's because of the eroding impact of inflation over time. Very slow, but it has a huge impact on net worth. And so having things that can buffer that, I think is really important. Is 7% inflation here to stay? I hope not. Might be.
Michael, how about you in terms of positioning your portfolio in terms of inflation?
Yeah, so I wouldn't say we've made any dramatic repositioning trades in the portfolio because of inflation. I think if you think about how we invest and kind of the process that we use to go through and pick stocks, it definitely has been a focus on companies that have pricing power, right? And I think that's really critical. I echo the comments you just made. I mean, some of these things are going to linger a lot longer. If you're just broadly speaking buying the S&P 500, you're going to be buying a lot of companies that don't have pricing power, which means their margins are going to get hit, which means you're going to have negative earnings revisions, which means the stocks aren't going to work. So I think you've really got to be focused on the companies that can actually pass through those higher costs. I'll give you one example. It's actually a company we don't own, Sherwin-Williams, which makes paint, right? So last year, Sherwin-Williams took 3 different price hikes throughout the year, and they ended the year charging 23% more per gallon of paint than where they started the year. And even at that higher price, they still couldn't get their hands on enough chemicals to make enough inventory to meet demand. So when we're out there looking at companies now, it's, you got to have access to inventory because there's so many issues in terms of bottlenecks and supply chain issues. You got to have pricing power. And so that's why I think that in this kind of an environment, you have to have a concentrated stock portfolio, and you don't want to own the market broadly because you're going to get too much of that stuff that could struggle if this inflationary environment does run longer.
Yeah. Ken, is there any play on the bond side with inflation?
No, bonds are not an inflation hedge, just put it that way, unless you use tips or something like that. The interesting thing about municipal bonds this past year in 21 is that we had tremendous demand for municipal bonds. And I think a lot of it was driven by M&A. I think they had a record year, in issuance of doing M&A work. And for us, we have seen a lot of that. I think we've seen maybe about $800 million over the last year and a half that has been basically from an M&A type situation where people sell out, or a person sells out their business and they get handed 50, 75, some cases $500 million. And they looking for a short-term place to put it and so forth. And we've seen a big demand in municipals, especially short-term municipals, this past year. So I don't know, there's just not really a place to hide unless you just, like I said, you just stay in the front end of the curve, have a duration of 2 years, and keep rolling them out and so forth. And then hopefully if you're rolling them out, at higher rates.
Just to add on inflation too, we've talked about the impact of higher input costs, but we also know that wage inflation is running a lot hotter now than it has been the last 10 years. I mean, if you think about it, today there are 1.5 million people more unemployed, we're 1.5 million people below where we peaked in terms of employment in 2019, and we have 10.5 million open jobs, okay? So if we get those 1.5 million people hopefully back to work in the very near term, we're still gonna have 9 million open jobs. How on earth do we fill 9 million open jobs without wage inflation if we already are at peak employment to where we were in 2019? Certainly you've had population growth, you have a little bit of productivity, but overall, you're not going to fill those 9 million jobs without experiencing some pretty material wage inflation.
What about AI?
Yeah, so that would fall into productivity, right? I'm thinking in my head of the Super Bowl commercial. I think it was Chick-fil-A, right? It was showing the bags be put on like the runners out to the front counter to deliver people's food. Yeah, there's no doubt there's productivity improvements, but I don't think it's enough to offset those 9 million open jobs that you see out there. And really the saddest part of all this is that we waited for over 10 years post the financial crisis for the bottom quartile of household incomes to see wage inflation. And they really just started seeing it in the last 12 months. And what's happened? It's actually negative real wage growth, right? Because you're getting 5% wage growth, but you're getting 10% inflation, so the purchasing power of your wages is actually down 5%. That's the saddest part of all this. And if I had a solution for it, I'd probably be outside with a megaphone running for office, but I don't have one. Yeah. But when you do that simple math on it, it's very unlikely that you're going to see those things cooling off.
Yeah, they're going backwards, even though they're getting pay raises and
Yeah,
so forth.
the purchasing power of it's just going down.
Yeah,
Yeah.
it's just sad. It's the middle, it's the middle.
Yeah, think about it every time you fill up your tank, right? What was it, $3.15 a gallon here? I'm from Boston. It's close to $4. You were saying you saw $6 in
$6.
California. You know, that hints into it.
Yeah, and it's the common guy that's really getting hurt on this whole process.
Yeah.
And the gap between the haves and have-nots is getting bigger and bigger, and that's a major social issue there and so forth. Yeah.
Mab, let me talk a little bit about current valuations. What's your take on where we are right now?
Well, I think U.S. stocks, market cap weighted, are probably some of the most expensive they've been in history. So what, right? That doesn't mean they're in a bubble and they have to crash, but our expectation is zero real for the next decade. That having been said, when you talk to people about market cap weighting, right, you don't have to buy the market cap index. In the 1970s, that was a huge innovation. Why was it a huge innovation? Because it let you deliver a portfolio for no cost. Because why? You didn't do anything, right? And the only input is the price of the stock and shares outstanding. The problem with that, there's no fundamental tether to reality. So we were talking about active management. Anything beats, I mean, market cap weighting is great, okay? Great starting point. Pretty much anything beats market cap weighting by a couple percent per year. Equal weighting, you could weight whether someone is wearing green shoes, brown shoes, black shoes, doesn't matter. That should beat market cap weighting over time because there's no fundamental tether to valuations. So if you look at the broad market valuation, we use 10-year PE ratios, doesn't matter. Any valuation metric you use today would say that the broad stock market is expensive. Use broad market valuation, we're looking at zero. However, if you look at value, so the cheap stocks, if you go back to the 1920s and you look at the cheap versus expensive, historically, cheap beats expensive. It's a really dumb idea. You want the best piece of advice today? Don't buy stupid expensive stocks. That's a horrible idea. Horrible idea. A lot of people are doing that today. Cheap versus expensive had its worst year ever. Guess what? When I graduated college, 1999, right? The dot-coms. I can see some of y'all. See you bought CMGI, Pets.com, Lucent. You guys remember those names? Some awkward laughs. Guess what? That was followed by the best year ever for value in 2000. Market imploded, internet bubble rolled over. That was until 2020. 2020 was worse than 1999 for value stocks. 2021 was good, but if you look at the historical value versus growth, you can look at this slice 1,000 different ways. I think it's a generational opportunity for value stocks in the US versus the expensive stuff. I think that's also true for US stocks versus foreign. Finally, we can disagree about something. But it's the biggest valuation spread we've seen in 40 years. What happened 40 years ago? The US was cheap. And guess who was expensive? Come on, anybody, the old school people in here, Japan hit a P ratio of almost 100. All the books were about Japanese business model. All the books were about how the Japanese economy was taking over the world. Their stock market's gone, and by the way, Japanese stock market, not some backwater tiny market. It's #3 economy in the world, still. It's gone nowhere for 30 years. I'm sure, I am certain that our professor here, the #1 thing, if you were to the iron law of investing, stocks outperform bonds, right? But it can go a long time when stocks don't outperform bonds. Most people, the Robin Hooders in the crowd, come on, a couple years, a couple hours, a couple minutes. They can go decades. In 2020, the long bond versus US stocks went 40 years, similar returns. And so you have these periods. It's hard to become asset class agnostic. If you're wedded to something, I don't care if you're a gold bug, you like internet stocks, you like Canadian miners, you like cannabis, you like NFTs, whatever. You need to take a step back and say, I'm going to be a stoic, I'm going to be agnostic. Every asset class has its time in the sun, whether it's gold, wheat, Swiss franc, and its time in the shade. Our belief is that this is probably a time where market cap weighted US is going to really struggle, but huge opportunity in value, huge opportunity in a lot of foreign markets for the next decade.
All right, so we started off on the same page, and then we just kind of went in our opposite course. You know, I think what's great about this, and you know, you can always sort of detect when there's a lot of risk in the market, either up or down, because you turn on CNBC and every single opinion is exactly the same. That's when you know there's a lot of risk. When you have diversity of opinion, that's when you have healthy markets. And I think right now, you know, is a great example of healthy markets. You know, my personal view would be, I would not focus on value versus growth. So I can give you an example. When I would go to California and I would drive up the driveway to go meet with Google's management team, it did not say, welcome to Google, a large cap growth company, right? It just says, welcome to Google, or now it says, welcome to Alphabet. I think that, you know, when you think about this kind of a market, you just really got to be focused on the names. I think about our strategy. We don't care if a company gives us a great total return from buyback, dividend, and earnings growth, or if it's just from earnings growth. We just care that we get that total return that we like enough to own the stock. I think when you get into this idea of value versus growth, you know, you get out over your skis and you can get caught in a bad position. So, you know, similar to what I was saying before, when you're building your portfolios today, you want to be focused on those individual companies. And to think about it in your head too, right? Facebook, or now Metaverse, or Meta Platforms, that stock recently got hit after an earnings sell-off. And today, Facebook and IBM traded at the exact same multiple. If I told you you had to, you know, I would say most people would say, well, Facebook is a growth stock and IBM is a value stock. Well, they trade at the same valuation, so I don't know how you define that. And the other thing I would say is if I told you you had to buy one of those two and close your eyes for 5 years and not trade it and then wake up, which one do you think you're going to be better off in? You would think you'd be better off in IBM? Okay. Well, that's a healthy market then. That's a healthy market debate. Yeah. I don't know, our preference would be to own Facebook, but you know, I think that again, that's a reflection of a healthy market, right? If I want to sell a stock at an all-time high, you got to be willing to buy it.
Michael, you've been mentioning some names. How about, did you mention some names that you were looking at, or can you do that? Or can you do that?
We can do anything. We're in Jackson, Mississippi. You know?
Okay.
We're all
$9 beer.
we're all friends here.
We will put it on Facebook.
Yeah.
Though I think this is being live streamed, right? So,
The best part about being a quant is you don't have to have an attachment to anything. And I think probably the biggest challenge of being an investor is the emotional side, right? It's very real evidence. You use a different part of your brain when you're making money and losing money. Losing money, you know what you're not doing is going over to your neighbor and saying, hey, did you buy this stock? I told you, look how much it went up, right? You're not thinking about vacations and how smart you are and opening your statement, checking your phone 10 times a day. And it's a flight response when you're losing money. And stock market's only down 10%, right? That's nothing. I mean, you got to remember the times when, and this is normal, markets go down 50%. That's happened twice in the past 20 years, right? 20% down in a day, Russia, right? That's happened in the US. That's normal. Normal market returns are extreme. That's just part of playing this game. And in some countries, you know, down 80%. That's happened in the US. It's Great Depression, but it happened, you know. Our grandparents' generation for a lot of us, but people lived through it. They were scarred for life. You want to go read a good book, you read A Great Depression, a diary. Anyway, not depressed people. All right, so what do I like?
What do you like?
My two big fundamental tenets are value on one side, which points towards value stocks. It points to, we actually heavily weight towards companies that generate a lot of cash flows and pay that out through dividends and buybacks. So what you call that, I don't really care, but I agree with you on that. I think those companies will vastly outperform the really expensive stuff that doesn't do that has no cash flows. I think a lot of foreign countries are, if you're willing to take the career risk, which many aren't, are a great opportunity, generational opportunity. I think emerging markets are too. And I think most people are woefully underallocated to that, first of all. foreign markets, but also real assets in particular. I think almost no one has any enough for it to matter.
What about foreign markets?
Love them,
No, you're-
yeah.
I mean, tell me which one, though. We're
Well, so most of when you talk about this home country bias, like don't feel bad. It happens in every country. So
Yeah.
Japanese put all their money in Japanese stocks. Canadians put all their money in Canadian stocks. Russians, they put all their money in Russian stocks. Every country in the world has this huge home country bias, and it's natural, right? Like I'm a Broncos fan. Any Bronco fans here? No. You guys are Falcons fan? Well, a couple, right? You know, it's natural. It feels warm and fuzzy and comfy. You feel like you really understand Apple and Amazon, but do you? You know, who's the CFO? You don't know. So foreign markets, just first step is moving towards the index weight.
Yeah, you're not Argentina, though, right? You're away from that. Okay.
You know, no, but I would buy it. You know, but again, I think almost anything. So U.S. for us, long-term PE ratios is in the high 30s. Foreign developed, let's call it mid-20s. Foreign emerging 15. The cheapest countries around the world are around 11, so a lot cheaper. But again, it's not always the case where the U.S. is expensive. That's rare. You know, the U.S. is often some of the cheapest. U.S. PE ratio has been as low as 5. On the long-term basis, but these things go through cycles. This plays out over 10 years. You guys have me back in 2032. We can talk about it.
These ones that are 11 PE, which names are those?
You guys really ready for it? Are you prepared?
It's not Turkey, is it?
Turkey's in there.
No.
You guys ready to buy some turkey? See, this is why it's unpopular. Is that like if you look at, there's a very, very high correlation to the things that are at all-time highs and higher PE ratios, and things that have just been bombed out, they're in low PE ratios. Why? It's the P in the PE. It's usually not the E that moves that much. It's right. It's something that's down 40, 60, 80%, and that's how it usually gets there. But there's the UK. UK and the US, 120 years, you look at the PE ratios, they kind of go back and forth, very similar returns. My favorite investing book, if you haven't read it, Triumph of the Optimists. Credit Suisse puts out a yearly update, just came out this week. Take a look at it, it's really wonderful. Get it at the library because it's $100. But the UK versus US, they go back and forth. UK is at like a 15 PE right now. They went through their whole Brexit thing, and you talk to people in the UK a couple years ago, they would say, oh my God, this is the mess.
World's coming in there.
And you forget, right? Like what were we talking about here a couple years ago? Pre-pandemic, I don't even know, Zika, like something else, like you know, it happens, and so that's what presents the opportunity. So places like UK, which you wouldn't think would be a huge valuation difference, is. Mm-hmm.
Ken, let me shift a little bit on topics and ask you about the yield curve, the flattening of the curve. What do you think about it? What do you think is indicating? Is there a reliable signal there?
Well, when you get an inverted curve, and I think that's what the market's looking at right now. When you get an inverted curve, just slight inversion and so forth, it's usually about 18 months till you have a full-blown recession. So it's really key what's going on now with the curve. Most people in the bond market, and I assume you guys in the stocks are looking at that as an indication that the economy is slowing down and that we might be running into a recessionary environment. So I think the yield curve today is the front part of the yield curve basically is an indication of what the Fed's been doing or what they're going to do, let's put it that way. In the 10-year and further out and so forth, I think people are, there's still a big demand there for our bonds, because if you look at Japan, you look at Germany, you look at these rates out there, we're pretty cheap compared to some of these other countries out there. So there's still going to be a pretty good demand for longer bonds.
Michael, this is interesting to me because we've seen it with our students, but the new wave of these retail traders that some are saying are changing everything we do. What's your take on that? What about the valuations? Are they?
So I teach in the MBA program at Boston University, and this time last year, right, you had all the meme stocks, and I'm trying to think of what the kid's name was that came out and did all the manipulation and got caught on, what was his name?
Oh, yeah, I know what you're
Yeah, you're thinking of the story. I can't think of his name. Anyway, the students in my class, they talk about it all the
Talking
time.
about Roaring Kitty?
Yeah, Roaring Kitty, that's what I
Or
couldn't think of.
deep effing value?
Those meme stocks that they're trafficking in, it's not something, frankly, we haven't owned any of them. Does it bring to light some issues with the market? It certainly does, right? I mean, they highlighted some of those stories where there was more shares of a company short than actually outstanding. I think we can all agree that that seems a little funky to us, and that you need to have some more regulatory oversight of that so that it doesn't repeat itself in the future. But those names, I mean, those just aren't the names that we're trafficking in. So, the retail investor, I think they'll be there as long as they're making money. Right now, probably struggling to make money like they have been in the past. But I wouldn't say the stuff that we traffic in that we see the impact of that on a daily basis.
Matt, would you track them? Would you follow them?
Don't ask me this question. I think the long history, and look, this was me in the late 90s, when I was a student. I think it's the best thing that can happen to a young person, and there's a few here, is you lose all your money, right? You experience the very real pain. And it's not a theoretical, it's a very real physical pain of losing money, particularly when it's money that matters. So hopefully it's not when you get older and have a bunch of kids and a mortgage, because that can be change the trajectory of not only your life, but a lot of people surrounding you. But embracing that failure, right? Being happy about it. No one wants to be happy about it, but going through the losing as a wonderful learning experience. And let's be clear, if you're an active trader, you're going to lose. And I say that because there's evidence. All the evidence says that. The Forex brokers, you guys remember Forex trading? They had to publish publicly the percentage of their customers that made money, and it was 2%, right? And so Robinhood, who I have a very public rivalry with, I think it's it's not a game. I mean, I think it's good to learn, and there's great entree into this world. I think we talked about this earlier. I think it's a travesty we don't teach personal finance and money in school. 15% of high schools teach it, but not even high schools. I think we should be teaching it as early as elementary school. And what are we teaching? Latin, all these other subjects that none of us use ever again. But money, the most fundamentally important topic. I heard a great quote the other day, and I don't know who to attribute this to, so if you know, grab me later. But it's like, you may not care about money, but money cares about you, right? And so to learn and get these experiences and lose, that's fine, because you figured it out, but it's hard. So I relish the fact that a lot of these apps are onboarding people, millions and millions of people into financial markets that were never exposed to that before. It depresses me to no end that they teach them the wrong lessons, right? I think the exact opposite of what Robinhood does, which is you should be able to buy companies and then you're stuck with them, these investments, for years on end. But the hyperactive trading, I think the lottery mentality is really unfortunate. Because and this is a long topic for me, and it's a funny bone topic. It really hits home. Is that I think more than anything, we should be encouraging everyone in the population to be an owner, right? To be a participant in the markets, and no other way to compound money than to be an investor in anything. It actually doesn't matter what you invest in over long periods. It could be indexes, but I think there's a great way to do it, and we can just rely on some of these professors to help us with it.
I saw something the other day with Shaq O'Neal. He was on TV, and he had a piece of paper out like this, and he's trying to help some of these athletes that have gone through a lot of money and so forth. And he said, here's the sheet of paper. Here's here's your paycheck, right? He says, and very simple, he tears it right in half. He says, this half is for spending, this half is for investing. So he made it very simple and so forth, and kind of what you're saying there, you want people to be involved, but you don't want them to be that greed, making money overnight. That's when you really start making mistakes. But investing, I think, especially for some of these athletes that he talks to and tries to get them to save their money.
We're talking about things that are fairly recent, so I have to ask about crypto. So, Michael, Meb, what's your take on cryptocurrencies as part of your portfolio?
So I guess if we're disclosing our portfolio, I have no ownership of any crypto. I've looked at it so many times. I've talked to really smart people. I just can't get my arms around it. I think it's, I think a couple things I would say to that. One is you look at all these brokerage platforms that are launched. Almost every week there's an article about one getting wiped out from hackers and somebody running away with your Bitcoin or your Ethereum and you're never getting it back. I think it's the new global central bank for money laundering. I don't see the value to it. It's gone to wherever Bitcoin is today, $40,000 or whatever it is, so I've been wrong on the way up. But I can't make sense of it. I mean, I'd much rather own a portfolio of stocks or stuff that I'm more familiar with than a crypto, because I can't explain it to you.
Well, somebody's buying it, though.
Somebody's buying it, yeah. I mean, don't be the last one out, I guess, would be my best advice,
exactly, right? So it's hard to understand that. I'm with you on that, Michael. I don't understand it. I'm old school type stuff. What's behind it, and all you can see is this thing has been so volatile.
Yeah, it's always going to be here, though, right? Because there's a lot of tech visionaries out there that are just enormous and very vocal supporters and believers in it. So it's never going back to zero. But in terms of broad adoption, I think it's very, very unlikely. And people that'll say, well, it's going to replace the dollar as the currency or something like that. If we ever got to that point, I mean, let's go back to 2008. Let's say that, we no longer had the US dollar and we didn't have a Fed out there and all of a sudden everything was in Bitcoin. The financial system's gonzo, right? It's gone. So, if we ever got to that point, I would think the regulators would step in and block it. There has been some countries around the world that have actually stepped in and seized that from folks. I think China did it. Earlier this year or late last year, they seized cryptocurrencies from their citizens. So, it's always going to be there. People are always going to talk about it, but I'm not going to own it.
The Federal Reserve is starting to talk about doing a digital currency also themselves. Central bank digital currencies. They've got some feelers out trying to get some information from people in the markets. I don't know if you've seen that or not. But everybody would have an account at the Federal Reserve, and it'd be digital, and you could you would transfer money back and forth at the Federal Reserve level. But they're kicking that around now, digital currency for the Fed.
I'm from Boston, so I'll bring everything back to Boston here. In 2007, Gisele Bündchen, who's now married to Tom Brady, came out and said that she no longer wanted to be paid in US dollars. She only wanted to be paid in euros going forward. To a tick, that was almost the all-time high in the euro. You think about this Super Bowl, Tom Brady's face was all over crypto commercials during the Super Bowl. So do with that as you will.
Meb, how about you? Crypto part of your portfolio?
I don't have much to add. I mean, I think it's important to be curious. I think I've invested in over 300 startups in my career, and to a T, all of investing, and this is stock market too, is about power laws. And power laws is the big outlier winners, right? And so if you look at the stock market as a whole, all of the returns of the stock market is generated by about 10% of the stocks. The Microsofts, the Amazons, the Walmarts, the Apples, on, right? And that's true about a lot of things in life, but in markets, everyone knows that's true in venture capital and startup investing, right? Uber. VC makes 50 investments, one works out. That generates all the returns of the portfolio, right? But it's true in the stock market. A lot of people don't know that. Also true. I think the biggest misses for me have always been I look at something and I say, that'll never work. That's too ambitious. I remember seeing a lot of these come across my desk that are now 10, 50, $100 billion companies. And at the time, looking at that and saying, when they were $10 million market cap, saying that's crazy. So I think it's important to be curious, right? I pay a lot of attention to this. As a percentage of the global market portfolio, right, going back to the earlier part of the discussion, everyone wants to be all in or out. You talk to a crypto fan in this audience, and they will tell you, by the way, just like if you're a vegan or a CrossFitter, they will let you know. You've already heard about 3 different cryptos at dinner if you're at a table with a crypto person. But no one's ever like, you know what, I got a little bit in crypto. It's like, I'm 100% in, you know, so when I talk to friends about it, I say, you know what, crypto is a percentage of the global market cap's 0.5%. So put a 0.5% in. No one wants to hear that. They want to hear it's 0, it's a fraud, and nothing's going to come from it. Or they're going to hear it's going to change the world and the trajectory of everything. Well, you put in that 0.5%, it goes 10x. Well, guess what? You got 5%. You know, if it goes 20x, 100x, like plenty of investments do. One of my favorite old school stock market books called 100 to 1 in the stock market. So I think it's 50, 60 years old at this point. But it happens in stocks. It happens in a lot of investments. And the challenge for most people on all these investments, guess what? I'm speaking back to the Robinhood crowd. And I'm not going to ask people to raise their hands. Just think about it in your head. Have you ever had an investment that's gone up 100 times? Not 100%, 100 times, right? Not many people have. You know why? Because it goes up 2 times.
You're gone.
I just double my money. I am so smart. I cannot believe it. Look how much this went up. Well, guess what? The 2-bagger eventually becomes a 5, 10, 50, 100. And that's life-changing wealth. The problem with that, and a great example is, it could be Apple, it could be Amazon. It's like impossible to hold many of these investments. Amazon had a 95% drawdown, a bunch of 50% drawdowns. Apple's had a 75% drawdown in every decade, going back to the 80s, except for I think this past decade. Now it's a multi-trillion-dollar company. But anyway, I think it's important to at least be curious. If I was to look back at my biggest mistakes of all my investing, it would be that something that I dismissed, particularly when a lot of smart people are interested in it. And that to me is the big kicker. When you see a lot of really smart people, there's no more grifters and hucksters in crypto, my God. But there's also a lot of really smart people gravitating. So I think it's at least worth paying attention to.
Let me ask the question, what do you think the ramifications would be if you did have kind of an implosion on say, Bitcoin or some of these other coins and so forth? Would that, I mean, there are a lot of people invested in this thing, apparently. So what if you see what they did, went from what, 80 or 60 or 80 to 35, I think, in just a short period of time?
Yeah, it always seems to reset. I think you get a little bit of a shakeout of the weak hands, but to your point, I mean, the folks that are these all-in believers, I mean, they didn't get shook at all. They scrounged up whatever they could get, and then they bought more of it. So I don't know that these drawdowns are doing anything to change anybody's longer-term opinion on it. I mean, if you bought Bitcoin at $1,000 and you're at 40,000, you're still pretty happy. Were you more happy when it was at 70? Sure, but you know, you're still there.
And that's the beauty of creative destruction and free markets, and that's actually the way it's supposed to be. If you look at the historical distribution of just stocks, 2/3 underperform the index, half basically have no rate of return, a quarter straight up go to 0. So if you look at the top 10 stocks or whatever per decade, you know what we're not talking about? The Dutch East India Company. We're not really talking about IBM. We're not talking about the largest market cap stocks in the world from the 80s, which is a bunch of Japan stocks. If you talk about the cryptos from 7 years ago, there's really only one that's still in the charts, and that's Bitcoin. The other 10 gone, right? So that's kind of a normal feature of markets, and most will die, right? Like, it's just part of the natural evolution and creative destruction. So that, I mean, that's a good thing. That's a feature, not a bug. But which one you want to bet on? That's why, like, having an index fund, which is true in stocks, you're guaranteed to own the winners. Problem is, crypto index funds are stupid expensive.
Ken, I got a couple of Muni-related questions for you. One of them has to do with the infrastructure bill. Do you think that there's going to be an impact on munis because of it?
Well, you mean as far as the bill is concerned and so forth?
Well, just
here's
the money coming in.
Here's the issue with municipal bonds today. The market's about a $4 trillion market. And over the last 18 months, the U.S. government has given the municipalities 1.6 trillion. So these municipalities are sitting on just a ton of money. And I can't see them, with the amount of money they got, I can't see them coming back into the market issuing bonds. Now, and also too, going back to the demographics, you're going to have less issuance of school bonds, so forth. So the municipal bond market actually is one of the few bond markets that have contracted. Now, we've lost last year, we lost about 50 billion in assets in our markets, so forth. So the infrastructure will help. I don't know if it's going to help the issuance of municipal bonds, but it'll be used. There's something just happened recently in Pittsburgh, where you saw that bridge that collapsed and so forth. And I think there's definitely a need there, especially on some of our bridges for infrastructure.
I have a question on diversification. Do you think it's going to get harder to achieve, or do you expect some decline in correlations?
I think the most important lesson of being an investor is you have to study history. And one of the biggest lessons of history is that correlations aren't stable. A lot of weird stuff can happen. I think the assumption that, for example, stocks and bonds are uncorrelated is foolish. If you look back at COVID, most of the sovereign bond markets in the world that were negative or zero yielding didn't help during the COVID drawdown. They actually hurt, right? So all those people looking for their bond markets to help, it didn't. It actually hurt. So I think in general, if you look at a lot of the risk assets, stocks, real estate, commodities, I think you should never make an assumption those will protect your hide when things hit the fan. I think there's other strategies that will. Bonds, on average, have helped, but not always, again, depending on their starting yield. If you start at -1, it's probably not going to help. There have been other things that have helped historically. Value can help, but not always. You look at the global financial crisis, value got smoked. Foreign stocks certainly won't help. There's certain active strategies that could. Manage futures and trend following on average helps. Gold is like your crazy cousin. Sometimes it shows up, sometimes it won't. But on average it helps. You know, buying things like tail risk puts, can't say guaranteed in our world, but are designed to help. The problem with that is it's a real cost in other times. But one of the best things you can do is less about the exact portfolio design, because you really can't come up with a asset allocation portfolio that doesn't lose a quarter or a third on a real basis over time. If you go back 50, 100 years. I challenge you to. You can try. It's really hard. But that's just natural, right? You're taking risks. That's what you're getting paid for. So I think the best thing you do is have actually realistic expectations and understand the possibilities of what is going to occur, in which case then you're cool with it, or you sleep at night, right? Or it's something where you understand the risk tolerance to where if you're not sleeping at night, if you're waking up today looking at CNN, CNBC, Fox, whatever, looking about what's going on in Ukraine and sweating it, then you probably have too much risk in your portfolio.
Yeah, when you think about correlations, right, the way that things move together, to bring it back to Bitcoin, you know, this idea that Bitcoin is a portfolio diversifier just doesn't work out to date, right? That could change in the future. But right now, when you have the equity markets, Bitcoin also when the equity markets go down, Bitcoin goes down generally more than the equity markets. And, you know, so they're moving in perfect unison, so you're getting no diversification benefits out of cryptos.
Michael, you run a portfolio that is roughly 60-40 stock and bonds.
Yep.
And we've seen some articles that are saying the 60-40 mix is dead.
Yeah, I've seen a lot of those in my career, yeah.
What's your take?
So, you know, and again, I'm talking my own book, and I should also say that my family's entire net worth is invested in the fund, so I do have a vested interest here. You know, I would tell you that I still think that there's a very healthy place for a balanced fund. You know, I don't think the asset class is dead. I think when you think about it overall, right, if we do get this environment where you get a zero return out of equities, I think you said for the next 10 years, If that is the case, you know, we run a pretty concentrated equity portfolio that we're trying to outperform the market, and historically, you know, the track record of our team has been able to do it. How do we use fixed income? Are we really bulled up on bonds? You know, we're not super bulled up on bonds, but when you think about the benefits to a portfolio where you have equities and you have bonds, what do you get? You know, the fixed income piece of it can mute some of the volatility. So if I'm talking a lot about our strategy, but if you look at our historical track record, you know, when the S&P 500's gone up 10, generally we've been up 8, and when the S&P 500's gone down 10, historically we've been down 6. So if you're losing more in a down market and you're still healthy participation in an upside, I still think that's a really great fit. You know, when you go to a cocktail party and you talk about an awesome balance fund, it doesn't get a lot of attention. You know, if you go and talk about CrossFit or Bitcoin or something like that, people want to talk to you. But, you know, generally speaking, it's done very well in terms of performance long term. The asset class, not just ours. Yeah.
Let me close with 2 quick questions. The first one, and this is for all 3 of you, what is the worst investment you've made, and what lessons did you learn from it?
I can start if you want. So
Something comes to mind.
I moved to the suburbs with my wife in 2006, and I bought a condo. That was the worst investment I made. What did I learn from it? At the time, I thought I would never get a mortgage rate lower than 6%. That was wrong. The purchase of it was wrong. But you know, I guess you make memories in a home.
You made a great point. I don't want to gloss over the fact of skin in the game and having money in your funds. The average mutual fund manager has $0 invested in their own fund, which I think is totally insane. So having that, I think, is super important. You know, as a trend follower, so some would call that in the managed futures world, losers are a part of it. You know, your batting average, if you're 400, is amazing, right? So you're used to the losers. Some people can't handle that, right? They want to be right all the time, which in investing is not going to work out. The amount of time the average asset class spends in a drawdown, there's only 2 states. You guys get no choices. This is it. All-time high or drawdown. There's nothing else in between, okay? The amount of time an average asset class spends in drawdown is 80%. So 80% of the time, you're losing, meaning you're not at an all-time high. And for a lot of people, that is hard. It's unnatural. As a startup investor, of the 300 investments I've done, 100 will probably be straight up zeros, you know? So there's a lot. I can pick hundreds probably at this point. But I think that's trying to retrain the brain to focus on the muscle movement that matters, which is the big winners. Most you can lose on something is 100%. Most you can make on something is infinite. And so putting those 2 equations together, it works out over time. So whether you buy an index, the one last thing, you know, I think is super important as cocktail killers. People would often come up to me, and we run 12 different funds, so something is always doing poorly. People will say, Meb, how long should I give an investment? And I used to say 10 years. They say, Meb, this isn't working out. I bought your fund. I'm going to give it 6 months. It's doing terrible. How long do you think I should give it? And I would say 10 years. And they would laugh awkwardly, and they'd see me just staring at them. And they'd say, wait, you're serious? And I say, actually, I've changed my mind on that. I think now the correct amount of time you need to give this is 20 years. And they say, that's crazy. And I say, well, this is not given to you, by the way, right? You don't get to choose what these returns are, right? This is the reality of the distribution of returns in history. And if you don't have that sort of time frame for an active manager, for an asset class, stocks have underperformed bonds for what, 60 plus years before? Your time frame is probably just not there. So anyway, be a good loser. Sorry, that was a little long. I'm a great loser.
How about you, Ken?
Well, it's not, from a bond standpoint, there was an issue in Washington, state of Washington, called Washington Public Power Authorities. and I thought this was a great deal, and it didn't work out. So anyway, that was one of my big losers. Yeah.
What did you learn from it?
Learn to read prospectuses a lot deeper. They had what they call a take or pay with about 23 different electric municipalities out there in Washington, and it was either a take or pay. You either would take the electricity or you'd pay for it one way or the other, and so they got a bunch of lawyers involved, and they broke that contract, and so that's what caused the thing to go from like 80 cents on the dollar to about 12 cents on the dollar.
But that's such a fundamentally important point you make about reading the prospectus, because how many people do that? Very few, right?
No,
and if you look at how many people buy a fund or an idea just because of the name, and you see this all the time when a stock will be in the news and the wrong ticker will see, enormous amounts of volume and flows, but that's just because people, it's like in the modern world of just reading the headline of the tweet and commenting on it, but not actually reading the article. Like that's a great example. Like who's willing to do the work, and most aren't.
Yep.
I think what Meb was saying before is so true. So I guess we'll come back on course together here. If you think about the hedge fund industry, right? They're trying to buy stocks and call every single tick in that stock right? Sell it up 2%, and then buy it when it's down 2% and keep doing that all the way up. There's so much money chasing that nowadays that I think there's a natural opportunity in taking a longer term view like that. So if you think about like how we invest, we kind of set a 2-year investment horizon. If we can buy a stock here and sell it here, that's great. Do we care what it was doing all along here? No. And in fact, there's so much money that's chasing it and is likely going to be wrong at many points throughout that course or trail that it's going to be on. Again, we just care about buying the stock here at the low and selling it at the high. In the most inefficient parts of the market, that's where the most opportunity is. Right now, being a longer-term holder of something is the most inefficient part of the market because there's such short-termism in the market today.
So one of the traditions of the forecast dinner, and really the reason you're here so we can pin you down, is we ask each one of our panelists to forecast the S&P and the 10-year yield 1 year from now. And let me give you the starting point. The S&P closed today at 42.88, and the 10-year note was at 1.97. So, Michael, you're first.
Wait, is this like Price is Right? So if it's whoever's closest? Because I'm just going to go one penny below what he says. Yeah. 1 penny above.
I didn't get my calculator either. S&P at 40. I think the S&P 500 is going to finish up probably about 4,800 or so. So that gives you a 1-year return of about 5% from where we started on January 1st. I don't think the market multiple is going to expand. I don't think it's going to contract. I think the market's just going to run with earnings growth, so that's kind of a mid-single digit return. And again, I think you can do a heck of a lot better picking individual stocks. On the 10-year, I would say on the 10-year, I would. So I got to give you a hard number or an over? All right,
You gotta give us a hard number.
I'll say the 10-year closes the year at 235, which
There you
is
go.
not all that much higher from where it is today. Keep in mind, the Fed controls the overnight rate. They don't control the 2-year, the 10-year, the 30-year. Those are all dictated by the market. So even as the Fed is raising rates, the 10-year does not have to go up. So, I would think that I think a good chunk of it is probably already in it, and it probably doesn't even go that much higher even as the Fed starts raising rates. I think the yield curve is going to flatten a bit. Hopefully not invert, but flatten a bit.
Ma'am?
Going back to what I said earlier about market returns, so normal market returns are extreme. The percent of time that stocks actually finish 0 to 10% is like tiny, minority. It's like up 20, down 10, up 4, like on and on, right? And there's nothing I love doing more than dunking on the forecasters because they all, in a narrow sort of band every year, and then the market just kind of does its thing, right? So I'm going to go, whatever the number is today, minus 20.
Minus
The
what?
bearish, minus 20%.
Minus 20%.
You just made Ken go 19.
And I'm an optimist, by the way.
Yeah.
You know, I think value stocks, if you remember back to the internet bubble, small cap value outperformed S&P by 150 percentage points over that bear market. So I think we're at that point.
10-year yield?
Was this morning, tonight? Okay.
Well,
Yeah, 10-year yield. You know what's interesting about bonds, which is a lot, by the way. If you ever read Liar's Poker, bonds are actually like the most interesting thing in the world. Bonds, no asset class necessarily Russia notwithstanding, necessarily just goes straight down. Often they'll have drawdowns, they'll bounce. Bonds, historically, when they go down on the 10-year, about where they are now, I think it's about a 10% drawdown-ish, 10, 15%. It's usually a great point to be buying them for the next year. So I'm going to go 197, you said? Mm-hmm. I'm going to go 197. So I think there's serious inflationary pressures, but I think given where we are today, it's probably good for some pause/bounce.
Yeah. Well, you know, I follow Lacey Hunt, who's an economist. I think a lot of people might know who he is. And Lacey basically does the 2 Ds, basically demographics and debt. And if you'll ever listen to him, he's a pretty good speaker. He's been around a long time. He was with McChesney Martin and Arthur Burns way back when he worked at the Fed. But he thinks that these two things will drive the economy. And he says the debt is such a burden for the economy, it's going to be very difficult for it to grow. Again, we've got a tremendous amount of world debt, 300 trillion right now. And so he feels that this is going to really be a governor on stocks or any kind of asset classes. He's very, very bullish on bonds. And the other D is demographics. And I know you mentioned something about the 30 to 49 growing and so forth. I think we added 335,000 people last year. And I don't know, if you look at immigration, who knows what it is, you know. But anyway, so he uses these two things, demographics and debt. And he does not see how our economy is going to grow any significant way out of that. So I would say, that being said, I would say flat on S&P. Okay. And I'm going to use 125 on the 10-year.
Oh, wow, we got everything.
There you go. Oh, yeah. There you go. But anyway, so that's my 2 cents.
I will tell you on demographics too. So we met with the management team of Procter & Gamble at the end of last summer, and they told us the statistic that at-home pregnancy tests were running up over 75% year over year.
Really?
So all those statistics that you saw at the beginning of the year, that last year was like the lowest record on births on record for decades. Really? Start looking out your window for people walking babies around.
Yeah.
All right. Well, Michael, may I have Ken, thank you.
Yes.
This was
Thank you for inviting
not just
us.
informative, but a lot of fun. Excellent. Is Ryder coming up to dismiss us, or we're dismissed? All right.
Thank you so much for allowing me to dismiss y'all. I just want to say thank you again for coming. Thank you so much. This has been an absolutely fantastic panel, every single one of you, and everything y'all said. I'm going to go back and transcribe it and then commit it to memory and then repeat it again in a year. Yes. And hold y'all to account. Also for the students, y'all are dismissed. Also for the students, do not forget your books and other award materials. Thank y'all for coming.
Thank you.